Hello everyone. Welcome to our channel. Today we are going to talk about a topic that, although it may seem a bit technical, is very important for understanding how the economy works and, more importantly, how it impacts our daily lives. We are referring to consumer confidence. Have you ever wondered what it is and how it is measured? Today we will discover it together. But before we dive deeper, here is a key question: why do you think consumer confidence is crucial for a country's economy? Think about that as we explore the topic. Consumer confidence is, in simple terms, a measure of how consumers feel about the current and future economic situation. It is a key indicator that reflects people's willingness to spend money. When confidence is high, consumers tend to spend more, which boosts the economy. When it is low, they may choose to save, which can slow economic growth. Now, how is this confidence measured? There are various surveys and formulas, but one of the most used is the Consumer Confidence Index, or CCI. This index is calculated from surveys conducted with thousands of consumers. They are asked about their economic expectations, their financial situation, and their willingness to make major purchases. For example, if in a survey 70% of consumers indicate they feel optimistic about the future economy, this translates into an increase in the CCI. On the other hand, if only 30% feel optimistic, the index will fall. This type of change can influence business decisions and, therefore, the economy in general. Now, let's look in more detail at how consumer confidence can affect the economy. During a recession period, like what we saw in 2008, consumer confidence plummeted. People felt insecure about their jobs and finances, and that led to a decrease in spending. Businesses, seeing a drop in demand, reduced production and, in many cases, laid off employees, creating a vicious circle. On the other hand, when confidence is high, as in times of economic expansion, consumers are more willing to spend. This not only benefits businesses but can also lead to increased business investment, more hiring, and, ultimately, more solid economic growth. But what factors influence consumer confidence? Some of the most common include economic situation, unemployment rate, inflation, and GDP growth are major determinants. Current events, political crises, natural disasters, or pandemics can drastically affect confidence. Future expectations: if consumers believe the economy will improve in the future, they are more likely to spend more today. Personal situation: changes in an individual's job or financial situation can also influence their perception of the overall economy. A good example of how consumer confidence affects the market is the period after the COVID-19 pandemic. After the lockdowns, confidence dropped dramatically. However, as vaccines were implemented and economies began to reopen, we saw an increase in consumer confidence, which led to a rebound in spending. In summary, consumer confidence is an essential indicator that not only reflects the current state of the economy but can also predict its future. The data from confidence measurements are crucial for businesses, governments, and, ultimately, for us consumers. So, the next time you hear about consumer confidence, remember that it is not just a number, it is a reflection of how we feel about the economy and how our decisions can affect the world around us. If you liked this video and found it useful, don't forget to like, subscribe and turn on the bell so you don't miss more educational content like this. Also, tell us in the comments, how do you think consumer confidence will affect the economy in the coming months? Thank you for joining us, and until next time.